Fundsupermart.com.
The Eastspring Investment Fund's monthly income plan invests in both Asian bonds and US high yield. What is your outlook for these two fixed income segments, and how is the fund currently positioned between them?
In general, credit markets have done exceedingly well in the last few years, and they can remain resilient if we were to continue to stay in a very low interest rate environment with very loose monetary policies across the globe. And indeed, over the last few years, that has actually been spurring the demand for yield assets, including corporate bonds. But if this assumption of near zero interest rates for longer is put into question, and there are these signs that that's happening recently, then obviously fixed income markets can correct in a big way. So specifically on the particular fixed income segments that we are talking about, high yield bonds historically has been less susceptible to a rise in the general levels of interest rates as compared to investment grade bonds, the latter being more correlated to US Treasuries yield, and hence they are more susceptible to a rise in interest rates. And fundamentally speaking, we are also very positive on high yield corporates in the US. Reason being, they have actually done a great deal in terms of repairing their balance sheets since the financial crisis. In terms of the credit matrix and in terms of their very low refinancing needs over the next few years, we continue to stay pretty positive from a credit risk or, if you will, a default rate perspective. And based on these factors, I'm more positive on high yield bonds as compared to the Asian dollar corporate bonds. And as a result of that, for the fund, we are slightly overweighted high yield bonds still relative to Asian dollar bonds.
The fund has the flexibility to allocate up to 20% of its assets in other Asia-Pacific investments. Under what conditions will the fund utilize this option?
If you look at the historical allocation to equities for the fund, that has been around about 5% so far. And obviously, the allocation will change and vary over time depending on our macro outlook and depending on the equity valuation. So if you look at the 5% at the moment, I think that's appropriate in terms of a modest allocation, given that this is an income type fund whose objective is really to achieve an attractive carry on its assets rather than to try to get huge capital gains on its portfolio. So, but of course, if equity valuations were to become compellingly attractive, then there's really nothing to stop us from increasing our equity allocation in a substantial way. And that has been done before previously. If you look at the financial crisis in 2008, the fund has actually increased its equity allocation then to more than 10% when the global equity sell-off gave us a chance to buy cheap assets at that point in time.
How did the fund perform in 2012, and what were the main performance drivers?
2012 was a very good year for the fund. The fund posted 14% return in absolute terms. And this is really driven by the very strong performance of its two core assets, which is the US high yield bonds and the Asian dollar bonds. And on top of that, the fund's allocation to Singapore high dividend equities, as well as the real estate investment trusts, have also done very well for the fund. And in terms of the high yield bonds and Asian dollar bonds, the very strong absolute returns that we have seen is really driven by a compression of credit spreads, with yields and spreads coming down more than 200 basis just within the year, have resulted in a very huge mark-to-market gains on the portfolio.
On the back of such strong returns over the last year, is it too late for new investors to buy into the fund now?
Well, as with any assets that have rallied so much, like what we have seen in the corporate bond markets, there is obviously near-term risk of a correction. But I think for investors with a medium-term investment horizon, I think one can still argue that credit market as an asset class is still attractive. If you look at the credit spreads and the credit yields that's being offered by the corporate bonds at the moment, notwithstanding them having come off quite a lot, but if you look at it in the long-term historical context, it is still pretty all right. It is still pretty attractive. And if you view that in the context of the strong fundamentals that we are still seeing in the corporate sector in the States, then the case can be made to have an allocation into the credit market still. I think yield is still an important component to an investor's portfolio, given that it is less volatile and there's more certainty, especially in comparison to equity markets. So for investors who do not want to have equity risk volatility and who still want to have a decent or attractive income on their portfolio, then obviously, corporate bonds can still be attractive to them from a medium-term horizon. Yeah. And I think it is a matter of managing expectations. I think the years of double-digit outsized returns from the corporate bond market, I think that's probably over. So investors probably need to manage their expectations for returns. We are likely to see more fixed income type returns going forward, similar to coupon income on their portfolio. And at the moment, the monthly income plan, it's based on its portfolio at the moment, is still able to earn a carry that's sufficient to meet its target payouts for now.
Thank you.